Hello, welcome to European Open Briefing for Wednesday, January the 17th. I'm Rafi Barajan, currency analyst at XM.com, and we're going to be taking a look at what's happening in the currency markets today. So the US dollar is attempting another rebound. It's having a bit of a roller coaster week. We saw it rebounding yesterday morning before turning lower again to hit fresh 3-year lows. It's attempting another rebound this morning. The euro, on the other hand, is not too far from its fresh 3-year highs. It touched earlier this morning when it broke above the key 1.23 handle for the first time since December 2014. The European Central Bank has been in the news this week amid several reports. The focus later today will turn on the Bank of Canada as it's expected to raise interest rates for the third time over the past year. The loonie, though, is a little bit softer this morning. The Australian dollar hit fresh from 4 months highs a short while ago following some upbeat data out of Australia, but oil prices have slipped somewhat from their 3-year highs. We've got inventory numbers coming up later today, so those will be watched very closely. So let's begin with the dollar. We can see both dollar yen and dollar index have been heading lower this week. Both hit fresh lows earlier during Asian trading. The dollar-yen pair hit 4-month low of 110.18 and dollar index hit 3-year low of 90.11. The dollar index has now recovered to around 90.70 and dollar-yen briefly broke above 110.90 before easing to around 110.75. So there's no new fundamentals driving the dollar lower. It's mainly on the back of expectations that other central banks will begin to tighten policy. And in fact, tighten policy, not just tighten policy, but tighten policy faster than expected due to a strengthening global economic recovery. So that reduces the divergence between US monetary policy and the rest of the world. There is some uncertainty, political uncertainty in the US as we've got another deadline for Congress to reach a deal on a spending bill by Friday. Otherwise, we could see a US government shutdown. The Republicans are proposing a stopgap bill that would keep funding going until February the 16th. But again, this means that this is only prolonging having to sit down and come to an agreement with the Democrats, with immigration being the main sticking point between the two parties. Let's move on to the single currency now. We can see the euro broke above the key 1.23 level earlier this morning before retreating to around 1.22, 22.30. Yesterday we saw some reports that cast doubt over whether or not the CSU party will be able to form a coalition with the SPT party after some regional branches of the SPT voted against the coalition blueprint that was agreed between SPD and Merkel's party last week. We also saw some reports suggesting that the ECB is unlikely to change its forward guidance and its overall language at the January meeting next week, and will likely keep its pledge on bond purchases for the time being, despite the ECB minutes that were published a week ago suggesting that the ECB would be thinking about changing its communication in early 2018. But we did see some downside pressure coming from comments from the ECB's Vice President Vitor Constantio, who expressed concern about sudden movements which don't reflect changes in fundamental with regards to the exchange rate. He also said inflation is still not meeting expectations, so that did dampen the euro a little bit this morning after that interview was released. Moving on to the UK pound now, we can see the pound also hit a fresh high, reaching 1.3836 against the US dollar. that comes despite the fact that yesterday we did see weaker than expected inflation numbers out of the UK. We saw UK CPI, the annual rate, falling to 3% in December from 3.1% in November. But more important, that was in line with expectations. More importantly, core inflation missed forecasts of 2.6 to fall to 2.5 from 2.7% in November. So that has raised expectations that UK inflation may be peaking now, and that would take away pressure from the Bank of England to raise rates again, or at least in the near future. We are seeing some fresh Brexit concerns on reports that the EU is now demanding tougher terms for a Brexit transition deal, and also Norway is threatening to cancel its arrangement with the EU if the EU was to give the UK a special trade deal. But so far, none of that has seen too much of a reaction in currency markets. The next real focus will be UK retail sales out on Friday. Moving on to oil prices, WTI has pulled away from 3-year highs it reached earlier this week. Brent crude managed to break above the $70 a barrel level. Many analysts are warning that the oil rally is overstretched, having gained 13% since early December. We might see US output rising again following a weak start to the year mainly due to cold weather. So rising US output may offset the cuts, some of the cuts being made by OPEC and some non-OPEC countries. So the API inventory numbers later today, and also the official inventory numbers tomorrow from the EIA, which also includes a UK production level, US production levels. So that could be important as to whether or not oil prices will be able to sustain their recent gains. WTI is currently trading around $63.75 a barrel. And let's look at the Canadian dollar now, because the Bank of Canada is meeting later today to decide on interest rates. They are widely expected to raise rates by 25 basis points to 1.25% following some recent strong data on employment and retail sales. We still have ongoing uncertainty about the future of NAFTA. That could, in fact, stop the Bank of Canada from raising rates today. They might decide to wait a little bit longer till there's a bit more clarity on that, as we've got more rounds of talks, NAFTA talks coming up in the coming weeks. But for now, markets have priced in a rate hike by the Bank of Canada. Although the loonie is a little bit weaker this morning, we can see USD CAD rising back above the 1.24 level, having dropped to a 1-week low 1.2392 yesterday. And let's have a look at the Aussie and the Kiwi now. We can see Australian dollar touched a fresh 4-month high of 0.17998, just below the key 0.80 level. So we could see a key resistance area forming there around that key handle. We had the Westpac Consumer Sentiment Index released earlier today, which showed it rising to a 4-year high in January, signaling an ongoing recovery in consumer spending in Australia, which had been on the weak side until very recently. That could potentially pave the way for an RBA rate hike later this year. We also had housing loans rising by more than expected in November in Australia. So the Aussie remains very much bullish. But if we look at the Kiwi, it has broken below its 21-hour exponential moving average. It did manage to top the 0.73 level earlier this week, but then we did see weak business confidence numbers coming out of New Zealand. Overall, business confidence has been deteriorating in New Zealand since the September elections. That could potentially impact on growth. And yesterday, even though we did see a 4.9% jump in dairy prices, that was the biggest increase in more than a year in the bi-weekly global dairy auction. That didn't do much for the Kiwi, as it's continued to pull back from its highs above 0.73, currently trading it has managed to settle around the 0.7250 level. And looking at today's economic calendar, we had stronger than expected machinery orders out of Japan. That puts the focus on the Bank of Japan when it meets early next week. We've got Eurozone final inflation numbers coming up later in the day, as well as US industrial output and the Bank of Canada decision at 15 hours GMT, as well as a speech by Cleveland Fed President Loretta Mester at 21:30 GMT. That's it from me. Thank you very much for watching and have a great day.